Mr. Patrick Horan, CIO and partner of Climate Endowment Group. I believe it's your first time with us, Patrick. Thank you for joining us.
Yes.
And Mr. Thomas Engelmann, Head of Energy Transition at KGAL Investment Management, specializing, I believe, in real estate and infrastructure and aviation. And Mr. Anish Dey, who is a regular guest on this program, Global Head of Power and Utilities for KPMG India. Thanks, gentlemen, for joining us. And today we're going to be focusing our discussion on what's next for climate finance. And we are taking a view very much this year on this program towards COP27, which will be taking place in Cairo, of course, in November, and kind of looking at our discussions from that lens of what did COP26 achieve and what do companies and governments need to be doing and focusing on as we head towards that sort of next target meeting, if you like. And today we'll be talking about finance. Patrick, perhaps I'll start with you as our new guest on the program today, just with a very simple question, and we'll go to the bulletin headlines as well if any of those caught your attention. But are we seeing enough finance, enough interest going into the climate net zero solution? And if not, why not?
I think that this answer, we all know the answer is no. No, we don't see enough capital going into this. The speed is still far behind than what is needed and also what's possible. I work with my company as well to offer investors the opportunity to invest, and we invest, for example, in hydropower. We're raising a hydropower fund for small, mid-scale hydropower, very clean solution. Yet the resistance or hesitance of investors is always astonishing. And so I think here the tone from the top hasn't really filtered down to concrete KPIs or let's say decision matrices for the people on the line to decide, okay, should I be looking at this fossil fuel or carbon power plant, which is now trading at a discount because people have left and I can see I can make 12%, or should I rather go for a 7% clean solution by ticking those boxes? And they don't have the tools yet really internally. I mean, that's at least what I see on the front line. And also on the top line, the strategic direction has not yet been reset. How do we make that trade-off? So it's more around like you have to maximize return inside the rules that are set, but the actual fixed barriers that people have for their investments are really not hitting them against the wall. They still have a lot of freedom to do, and at the end, return is still the all decisive metric here.
Yeah, I mean, so you would say that sort of this whole shareholder pressure within certain corporations to go more green, that's there obviously, but it's not kicking in enough to sort of turn people away from sort of a better bottom line.
Yes, absolutely not. I think that's clear that the bottom line is still measured in dollars. There are no additional metrics which are really taken into account for most investors that I can see.
Thomas, how much of this sort of hesitancy is to do, in your opinion, because of sort of lack of, let's say, policy even? I mean, Patrick was mentioning sort of strategies within companies, and KPIs, but in terms of generally speaking policy at the government level, whether it's in Europe or elsewhere, are investors shying away still from some of these solutions because of that, or are we at a stage where those directives are becoming more secure?
No, I think, Dayala, thank you very much first for inviting me and having me here. KGAL, we are definitely saying and looking for the market of energy transition. That means for us, it's very clear we have to decarbonize further, and we have to support the process of decarbonization worldwide with intelligent money. And this is now the point of KPIs, what Patrick has spoken. I think from the investors' we are very clear in which direction we want to go, because if we know that by 2050, most of the countries want to be decarbonized, at least CO2 neutral, most of the capex and the investments we have to do now have a business plan of 20 to 30 years. So if we start now to invest in fossil related fuel instruments, it means somewhere during the journey of 2050, you have a distressed asset on your balance sheet. So this gives a huge headache in the balance sheets and also in the discussions and KPIs of banks, but also on equity investors like we are doing it, if we analyze and evaluate the market. One second, and one word, what is necessary for going strictly this way. As you know, in Europe, we discuss heavily about what is sustainable, what is taxonomy, in order to help and support equity investors, but also debt investors, the capital market, to go into this direction. And we understand that it is necessary potentially for a certain period of time to support the ramp up of renewables and the transformation into other energy vectors like green hydrogen, with a certain time frame, with a prolongation of nuclear and gas. For us, it's a little bit a shame to be very clear here that you cannot bring at the same level a wind farm, a solar farm, a hydropower plant with a gas farm, a gas plant, a gas-fired coal or a gas-fired plant, or even a nuclear plant, because the last two ones, yes, they are CO2 better than a coal-fired plant, but they are not sustainable. They do have severe harms in investing us. For us as institutional investors, as I can say, is we look for ESG, and we cannot invest based on ESG regulatory basis. We cannot invest on this basis in a nuclear plant or even into the process of nuclear. And this is a little bit difficult for us because we have the fear that a couple of subsidies go now into a market what we do not want to have in 30 years. So why we invest in that further? If we need them, we need them. Okay, no problem. But don't bring additional subsidies into that market. And this is the political difference what we see from institutional investors.
I mean, and you mentioned the taxonomy in Europe, and Europe is sort of formulating that, and you know, as time goes on. Anish, welcome. Just to go to you on that, in terms of, let's take the lens from the region, let's say here in the Middle East, or even in India and Asia. India, where you're based, you know, from a sort of policy taxonomy point of view, you know, are we seeing, you know, it's a whole different ball game, isn't it, when you're looking at Asia in terms of the size of those economies and even the way that those countries are run. You know, how is there clarity there for investors, more clarity than we're seeing, let's say, in Europe? And you know, there's no doubt that we're not seeing enough investment into this solution. You know, at the end of COP26, there was a new $40 billion commitment asked from the private sector for the next 5 years. That's not nearly enough. So how can we draw more money into this solution, and how important is policy in that?
So policy is, of course, very, very important, Ella, and we are seeing patchwork of policy. We're not seeing consistent policies, or we're not seeing a single direction in policies. And there are multiple reasons for that. There are, you know, several of the countries have a resource problem, and, you know, the Middle East possibly has the ability to move to, say, solar, or even India has solar or bioresources. So policy, you know, making that transition is also a challenge sometimes because they don't have access to resources. And then there's a continuous dependence on high carbon sources. The second part of the challenge is the whole energy transition is accompanied by climate justice, just transition considerations, especially in South Asia, where that's a big challenge. And, you know, these are going to transform economies in various ways, because if you are on coal or oil versus you go to renewables, you know, the geography of energy gets disturbed quite significantly. And those are not easy problems to solve. So that's why you see sometimes, while directionally the policy might be making the right noises, the moment you get into the details, you start struggling with that. And the third point is that it is not a switch-on, switch-off situation. So just like you're going to ramp up clean energy and low carbon energy, you have to ramp down the high carbon energy. It just can't switch off, because we've seen what happens, and energy prices just go through the roof the moment you try to go into extremes. And that is a very nuanced play. It's not an easy play for policymakers to understand and act on. And I think that is the struggle which we are seeing. They don't know how to take that. If you're talking of science-based targets, sometimes organizations adopt it. That's also a new area. And the moment you come to governance, nationals and subnationals, they actually struggle with the whole overall construct. So I think it is going to be a little bit of feeling the way for the next couple of years till we get to some amount of certainty about the direction of policy and the direction of policy implementation. Yeah. I would say that it's a bit of a challenge.
Yeah, thanks, Anish. Patrick, just to go back to you on, your group works a lot with impact investment, and let's talk a little bit about emerging economies versus developed economies and countries, and how much of an extra challenge, Patrick, is it for finance when it is approaching funding certain projects in economies which are still growing? Of course, they're just at the start of their growth and trying to decarbonize at the right time, as opposed to developed economies which are trying to reverse certain systems. What's the approach of finance to that? Is it easier? Is it more difficult? Is it more attractive?
From a pure financial perspective, a growing economy, it's easier in a way because you don't need to phase out. You simply grow out the old fossil fuels, and so luckily, with the way where solar has been going and also where storage is going, actually these are financially profitable investments as long as you have enough sun. So let's say everything except for the northern regions works for that very well. The issue is, as always, emerging markets, they have a certain country risk attached to them, which reduces the available pool of capital. So I think that's the big
for example, in terms of how they're rated, for example.
Yes, how they're rated, the credit rating, the corruption index, and so on and so forth. And then that plays into, of course, the required rate of return. But either way, let's say if you have for the same amount of, let's say, hydropower, if you have 1 billion of investors ready for Europe, the same, for India, I'm sorry to take the example, at least from European investors, would be maybe at 100 million or 150 million, just because they say that's our risk bucket for this region. So at least from capital sources outside these countries itself or outside other emerging markets, that is the biggest restriction still. And I actually recently heard that from the United Nations pension fund, so the United Nations Joint Staff Pension Fund, who has all these countries at their constituencies and pensioners, I think less than 2% is invested in emerging markets.
Thomas, do we have the technology today available to really make sort of financiers or funds, comfortable with, for example, in the big sectors like transport, aviation, manufacturing, but put aside energy, but those huge sectors that are not easy to decarbonize necessarily. But is the technology there to make the finance world comfortable that it's going to be, a good return investment quick enough, if you like?
Yeah, Dayala, very clear to say, yes, it's there. There are technologies in the market which is already possible to invest. There are technologies in the market where we say this is more research and development, so a technology seed investment, but it's still available a lot of technologies which can be, let's call it this way, transformed from the old thinking of the oil and gas markets, because a pipeline can be used for natural gas. It can be used in the future also with a little bit of refurbishment for green hydrogen. If you start from the scratch where we have to start thinking, what is the prime energy source? It should be at least a CO2 neutral basis. And this means for us, this is so important that we really heavily have to invest in solar and wind and potentially also hydropower or biomass capacity in order to get the electrons into the market. And then the second question is, what kind of, let's say, transformation technologies are necessary in order to go into the hard to abate industries? The transport sector, as I said, is already in the way of going into the battery side for electric vehicles, let's say, in smaller distance and small sizes. The bigger the truck, the more you come to maritime or aviation, then you will realize potentially that battery is not the right instrument. But we're gonna have a lot of excellent technologies available where we have to go in order to use then either e-fuels, or we're going to use hydrogen directly. And this is the reason why we as KGAL, also as financial investors, we look in our investment scenarios to the whole value chain of where is the energy coming from. That means we are not investing in a hydrogen plant because hydrogen is sexy. Hydrogen is a molecule, it's done. What is for us important is the hydrogen possible because it's a decarbonized hydrogen? Yes, if this is the case and we can invest into electrolyzer business, this makes a lot of sense because the technology is there. The capex of solar and wind farms mostly are really came down to a very attractive part. And as Anish said, the volatility of energy markets to a high extent come from crisis, political crisis, wars potentially, and the situation of fossil related prices. That means coal, gas, or oil are the basis of the volatilities, because renewable energy is to a high extent is the price of the capex, because the energy source is hopefully in the future as well for free. So this is a different ballpark, and this means for us we have to go into this direction, and this technology is available. We have just to invest now into this.
And we're going in that direction undoubtedly. And you mentioned hydrogen, that's caught a lot of attention recently. That's blue hydrogen and green hydrogen. Arguably, green hydrogen will take quite a bit longer for costs to come down, for people to sort of make those commitments. And offtake, there's a whole debate about, do you have enough offtaker commitment, etc. Where do you see the sort of role, let's say, into this of blended finance? Perhaps I'll go to you, Patrick, with that. Actually, I mean, we've got the private sector investing, and you've got the public sector. Are we seeing enough cooperation on the sort of PPP front for climate solutions, or are we still stuck on a sort of two-track process, if you like? Of course, it varies from region to region, but do we need to see more cooperation on that front? Are we seeing the private sector interested enough in that?
I think we need from everything something. No? So we definitely need more cooperation also on the blended finance. There are always good projects that are being announced. When you then actually knock at the doors, the hurdles to get to a blended finance are extremely difficult. So there also needs to be a little thinking through what is again the criteria for the various teams from these development banks to actually get into something, and also to make sure that it captures more than one theme. Because always like, oh yeah, we only want to finance solar power plants on this kind of soil and this kind of region. Oh, it's in the next region. No, we can't do it. So you can't actually have bigger programs, and investors like diversification. You know? So it's like one side says, no, I want just this one region. The other says, I want to have multiple regions with diversification. So there's a bit of a mismatch in terms of what each side needs to really cooperate. You know? And I think it's easier to adjust on the blended finance side because this is a political decision, so to speak. You know?
Anish, I mean, as we look towards COP27, and you know, obviously having just completed the previous meeting in November in Glasgow, you know, what should be on the finance world's agenda, if you like, to focus on? I mean, what are the next priorities that financiers, funds, etc., are looking for? What guidance they're looking for to be able to sort of push their portfolios more in the right direction?
Right. So you know, the location of COP27 is Sharm el-Sheikh, and you know, I expect that a lot of the issues will focus back into development and the concerns of the developing economies as compared to COP26, which was more about climate, and there was a clear voice there that you know the developing countries and their needs, the growth needs, have really not been heard adequately, or the just transition needs have not been heard adequately. So I think the whole ESG, just transition, those kinds of agenda, which is more about the social agenda, I think you will find a little more you'll find a little more about supporting growth in the developing economies, because in Africa or South Asia, if they really can't scale up or match up to the requirements, and they keep on fossil fuels, given the mass of humanity which lives there, we will have a challenge in decarbonizing the world. So I expect that to happen, and I expect finance at least to be conscious of that and support that. So your question about blended finance, what Patrick mentioned about financing projects in developing countries, where apart from the risks which you mentioned, interest rate risk, the forex risk is itself a big risk. It's not just about the political risks which come, but the volatility of currencies is a big risk. So finding instruments which can actually assuage some of those risks and direct capital to where it is most needed, which is in these economies, I think that would be a thing for the finance community to look out for. We're already seeing some discussions around that. But yeah, there's a lot of fatigue after COP26. Everybody's gone home, and now they're kind of
well, you
regroup back.
You mentioned interest rate risk. I think one of our bulletin stories there today was about, how is, Thomas, I'll go to you on that. How's the current sort of macro central bank policy environment around the world, if you like, with inflation now obviously hitting hard after a very, very sedate period. Is that going to influence
Absolutely
the side of money, going in or not going in, to these projects?
It will. I think the macros are going to turn worse, and you're already going to see a massive amount of tightening of available finance, money available for this large-scale projects. And we are also behind the investment curve, as Patrick and Thomas have been mentioning. We are behind the investment curve. So the combination, that cocktail of things, actually is not a very happy cocktail at this point of time. We need to see how it plays out. But I have my concerns.
Thomas, what about you? What's your viewpoint on that?
Let's say it this way: if you look on the financial instruments, what financiers have in mind, I think there are always a couple of instruments which are neutral to inflation. So if, for example, we as KGAL, we go in development projects, in finance projects on real assets equity. That means if we're going to realize that inflation comes in, which is definitely not of attractiveness if we really come into high inflationary scenarios, as we say in the long run, as we have also in Europe, our laws saying a 2% inflation over a year in parallel with growth in the markets is acceptable. But if you not do anything against and just heating up inflation because you have and prolongate the time of cheap money, you have on the other hand also social related negative impacts. That means for us, we hope that we have instruments in place that we can definitely come along with normal inflation. What is not of attractiveness if we have high inflation, and not only in one or two countries, but in a lot of countries for a long duration, because then it's not so easy anymore. And Anish, as I was with Siemens, it was always a disaster for me to make calculation of Indian rupee back to dollars and euro, because this was a severe problem of development countries at that time, 20 years back, 10 years back. Look at Brazil, look at now what's happening in Turkey. At the long term, if you have inflation and you do not fight against the inflation from an economic system approach, from the political systems, at the long term, you really hurt the people and the society in the countries. So in the short term, okay, you can look into it, but in the long term, inflation should not be a part of your portion. And this means if you want to fight against inflation, that means you have to do something with interest rates. And this is exactly the part for us. I believe that the markets are prepared for a certain kind of interest rates. The capital markets are prepared for that as well, because what we have at the moment on equity side is really a boom because of low interest rates, and sometimes not because the equity valuation of company is perfect in place.
Yeah, and a lot of money still flowing in the system. Patrick, just back to you. I'd like to address the question of carbon markets. It's always a sticking point. It has been so far. It's like, how do we achieve the perfect carbon markets, which would be obviously which would incentivize the parties in this whole game of mitigating climate impact. We haven't sort of found that solution yet, have we, in terms of the offsets and how we can regulate that? I mean, is it possible to foresee that there will be a system that the players that can use?
I think it is foreseeable, and that's where we want to get to. It is a complex problem. So let's say right away, the carbon market is a complex problem, but also it offers a solution to the financing gap. Because think about it, right now, the European Union carbon credits cost around 95 euros a ton. And people doing projects in emerging markets to capture carbon, they're calculating production costs of 3 to 6 euros per ton. So if we can find a way, and that's where the regulation has to go, COP27 and so on, to make carbon credits fungible from one country to the other, whilst of course preserving the need for each of the countries to achieve their carbon goals. But if you have fungibility, that could unleash a huge amount of investment from the Western world, from corporates especially. So set aside institutional investors, direct corporates, to try to cover their needs of carbon credits by providing money to projects in emerging markets.
Okay, and I mean, why haven't we seen that already? Do you think why haven't we seen that solution adopted?
Yeah, that's a good question. I mean, it is on the one hand complexity around calculations. I think that's where we struggled many years with. How do we actually calculate a carbon credit? This concept of additionality, that something happened just because you did now something, not just because the forests keep growing. No, that's not a carbon credit. So that took a while to crystallize. And I think we're almost effectively there. The standards have been set. A few countries have done very successful regulations. So now we have actually good examples on how it can work on a regulated market. And now the cross-border trade is always the most difficult one. How to achieve the cross-border trade, recognizing each other's carbon credits, make sure that nobody can double count. So it is a complex problem, but I think also the amount of finance flows, that's really a part of the solution.
Anish, I'll go to you for the last word today, just on this question of, and again, I think at COP26, this came up because the world was having a bit of an energy supply crunch, and we are still in a very tight market. And of course, this is going to happen again, for the next few years until green solutions catch up and are able to sort of supply what conventionals are doing. So is the financial market looking at that and being reminded again today that there is still reason to continue to invest in, maybe not in coal, obviously, and oil, but certainly in natural gas? There's certainly appetite from European banks, still a huge appetite into sort of natural gas projects, which yes is seen as a transition fuels, but a lot of economies like India, for example, are seeing it, and China are seeing it more than just a transition fuel. They're going to need it for a long time. So what's the approach from the finance sector on this? When you get an energy crunch, supply crunch, do things sway?
Yes, so I think today, if you look at countries in South Asia, including India, new financing for coal-fired power projects is not available. Okay, so it's kind of come to pretty much a complete halt. But that might really not serve countries which are having a growth rate of economic growth rate of 6 to 7% GDP, and given the demographics is to continue for say 15, 20, 30 years. So what is important is to recognize that growth reality, which I talked about earlier, and recognize that given the resources limitations, certain amount of projects might be needed as transition projects. Okay. And this is not going against the cause of action. And corresponding to those identified classes of projects, we need to have transition finance available, and that so that it doesn't get tarred as financing coal. You have some headlines today where you're talking about financing coal or financing high carbon thing. But for some period, it will be necessary to put a frame properly around transition projects and transition finance is necessary. I don't think we've talked about it in concept, but honestly, there's a lot of work to be done there.
Yeah, and it's certainly necessary. Well, I'm afraid we've run out of time. Anish Dey, Thomas Engelman, and Patrick Horan, thank you so much, gentlemen, for joining us today, and we hope to have you on the program again. Thank you so much.
Thank you,
Thank you to our viewers.
Thank you, Dayala.
Thank you.